every day we're getting closer to a major stock market crash or a financial crisis or both. And I think the only thing that might derail this in the short run, of course, nothing is going to derail it in the long run. This crisis is inevitable and will happen. But Powell is going to have to come out and do something drastic to change this narrative. Otherwise, this is going to happen. And, whether it's tomorrow, the next day, the next week, it's hard to tell. But what seems apparent to me is that we're about to go over a cliff. Just don't know how much, more distance there is between where we are now and the edge of that cliff.
Peter Schiff, renowned financial expert, paints a stark picture of the impending financial crisis. He warns of an unavoidable market crash driven by soaring interest rates and the collapse of bond prices. Schiff emphasizes the gravity of the situation, highlighting the historical significance of current yields, comparable to those just before the 2008 financial crisis. He reveals the dangerous foundation upon which our economy stands, a shaky structure built on cheap money, with governments at all levels drowning in debt. Schiff's foresight, evident from years of predictions, underscores the urgent need for drastic action. As he delves deeper into the consequences of the impending crisis, you won't believe the shocking revelations about our economy's vulnerabilities. Stay tuned to find out why Schiff believes the end of this economic facade is inevitable.
But we're going there. And what's going to push us over the edge is the rise in interest rates, the collapse in bond prices, which is continuing relentlessly. Now, this is not something that should be a surprise. I have been warning about this not only in recent podcasts, but over the last several years, that this was going to happen, that interest rates were going to rise a lot more than the markets were prepared for. Not only rise a lot more, but stay higher for a lot longer. And that is what we're seeing now in the bond market. Bonds now are at their highest yields since before the 2008 financial crisis. If you look at the yield today on a 30-year Treasury, it closed at 4.7%. Now, that's still a very low yield, but again, we haven't had yields this high since the 2008 financial crisis. The yield on the 10-year is 4.56. Now, we're getting very close to 5%, which is still a low rate, but most people might not recognize this. But the last time the 10-year Treasury yielded more than 5%, it was 2001. And the yield got to like 5.2 or 5.3, so it barely got above 5%. We are almost there. Now, there's a big difference because back in 2001, I think the national debt was 7-8 trillion. Now it's 33 trillion. We have a lot more debt now than we had back then. So this is a much bigger problem, a 5% 10-year. I mean, we're not there yet, but at the rate we're going, we will be there soon. And what nobody seems to appreciate in the financial media is they are looking at the beginning of the end of this whole phony economy, because the economy is built on a foundation of cheap money. It's not just the economy, it's every facet of it. The government, the deficits, the government budget is built on cheap money. And it's not just the federal government that's been gorging on this cheap money. A lot of the state governments, municipalities, they've all issued a tremendous amount of debt over the last 15 years. That's about how long interest rates were at zero, except for the last year. Again, remember, what was everybody saying when money was cheap? Great time to borrow. Take on debt. It's cheap. Borrow. Everybody borrowed because it was so cheap. And what was I saying for years? This is a mistake. I said just because it's cheap doesn't mean you should do it. My analogy was, should you do heroin if it's free? Oh, look, I can get all that free heroin. How can I pass that up? No, just because it's free, it doesn't mean you want to inject it into your body, because eventually it's going to cause a problem. And that's exactly what's happening now. I knew that all that, cheap money would come back to bite the people who borrowed it, because eventually interest rates would go up and the debt would still be there.
In the next segment, Peter Schiff highlights the alarming rise in interest rates and the continuing collapse of bond prices, emphasizing their historical significance, comparable to pre-2008 crisis levels. He criticizes the misconceptions surrounding a 4% yield, pointing out its inadequacy given the prevailing inflation rates. Schiff dispels the belief that a return to 0% interest rates is imminent, debunking the idea that bonds will recover as they did in the past. In fact, he reveals that bondholders have faced significant losses, with bonds performing worse than stocks. Schiff predicts another challenging year for bonds in 2024, asserting that the situation is far from its peak.
And then what would they do? Well, we're going to find out, because it is a disaster in the making. I looked at the yield now on a mortgage. It's now at 7.9%. We're almost at 8. I was predicting this. I was calling for this to happen. There are a lot of people, when the yield on the Treasury bonds just got up to 4%. Oh, this is a great buy. You got to buy these bonds. A lot of these bond investors, oh, these are great yields. It's a great opportunity. Buy the 10-year bond. You can get a yield. It's all the way up to 4%. And I was saying, well, what's so special about 4%? That's not a good yield. That's horrible, especially where the inflation rate is. But the whole basis of believing that 4% was attractive was based on the last 15 years of 0% interest rates, and the belief that 0% interest rates are just around the corner. That as soon as there's a problem, as soon as the economy slips, the Fed's going to go right back down to zero. And then if you're holding those long-term bonds, you're going to make a lot of money, just like people have in the past. Well, it's not going to work this time. In fact, people who have been holding bonds, they're down about 50% on their money from the peak in 2000. Bonds are getting killed. Bonds are down more than stocks this year. In fact, I don't think stocks are down, although they're down about, NASDAQ, I think, is now down 8.5% from its highs. But I think bonds are down maybe 10, 11% on the year. So minus whatever you got in interest, you're losing money on bonds on top of the worst year for bonds practically ever last year. In fact, this will probably be back-to-back the two worst bond years in the history of bonds. And I said that. I said that last year. I said this would be another down year last year. All the people that were saying, buy the dip in bonds, I said, no, the dip isn't over. It's going to be a lot worse. And in fact, bonds are likely to have another down year in 2024 because they're still not high enough.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.